Welcome. I'm Catherine Magana here with Rachel Ivanovich and Greg Carroll, where we're here to provide you insights on the markets, planning, and much more. Today is April 23rd, and here we are a week later, and the war is being viewed as less of a threat by many investors, even though we're still seeing some uncertainty and different news and headlines. But if you look at year to date where we're at, the markets are still in positive. We've actually had some gains from last week.
All-time highs.
Yes, it's amazing.
Higher than when the war started.
Yeah. And then Q1 2026 earnings season is off to a great start, with roughly 85% of the S&P 500 companies that have reported have been beating expectations so far. There's still a lot more to report over the next several weeks, but so far it's looking pretty positive. And here we are, a week after tax deadline. So Rachel's feeling a little more refreshed from last week.
Yes, that's for sure.
So looking at, like Greg alluded to, with some new highs, we actually were up from last week on the Dow Jones, up over 2%. So as of yesterday's close, which was April 22nd, the Dow Jones was at about 2.97%. The NASDAQ year-to-date is at 6.09%, so up over 2% or over 2.7% from last week. The S&P 500 year-to-date is at 4.27, which is up over 1.68% from last week. And the Russell 2000, which is your small cap stocks, is up 12.23 year-to-date, which is up almost 3% from last week. So obviously we're continuing to see some positive returns. It's been quite the year. We saw a lot of market movement, especially over the last few weeks. So we're happy to report that we're still in the positive. And so looking at kind of where we're at with kind of the upcoming rate changes, so we don't see any changes coming. The probability of no change for the next meeting is 99.5%, so pretty much no change there. Mortgage rates, pretty consistent. We're, as of this morning, the 30-year that I found on Wall Street Journal is at 6.32, and the 15-year at 5.68. So it's been pretty consistent the last few weeks with some of where the mortgage rates are at. And then looking at the one-year CD, it's at 3.95, so no changes from last week. And then the one-year Treasury is at 3.79. So obviously those haven't changed too much over the week. But the one thing that I wanted to share is kind of where we're at with the fear and greed index with the CNN. And so last week we were at 63, and this week we're at 68. But I thought I'd share a little bit about what that index is. So basically, it's a tracker that gauges the stock market, and it ranges from 0 to 100, with 0 being extreme fear, 100 being extreme greed. And so there's 7 different components that gets looked at: market momentum, stock price strength, put and call options, market volatility, junk bond demand, and a few others. But with the ranges, 0 to 24 is extreme fear, 25 to 49 is fear, and 50 to 74 is greed, and 75 to 100 is extreme greed. So we saw a pretty big shift over the last few weeks. Once again, being where we're at with greed, it's not surprising considering that the market's shifted a lot over the last several weeks.
It is surprising, especially with this war still going on. I think there's some ship being attacked or stopped by us or Iran or somebody, and yet the market really seems to be brushing that off for some reason. The earnings, like you mentioned, they're coming in very positive. Since I'm sitting in Vince's seat, I'm going to channel a little bit of my inner Vince.
There you go.
But earnings are doing very well, and they're expected to do quite well for the rest of the year, too. So, Vince has been saying, got to give him a shout out, but he's been saying it's earnings, earnings, earnings. And where's most of that coming from is the technology stocks. And the rebound that we've seen in the last couple of weeks has been extraordinary, kind of historical, actually, in some respects. So, when you get up to this, we're darn near in that extreme greed, right?
Yeah,
we're in the high
close.
60s. So, it's not something that you want to go just chase after, but, you want to make sure you're diversified, balanced. But the market seems to be in pretty good position right now, considering everything going on. But I would caution the longer this goes on, there is going to be some supply chain issues, and they will creep in no matter when this thing gets over. But the longer it goes, it will hurt.
Well, it's
earnings.
interesting you say that. I had a conversation with a client this week. They've been kind of thinking about doing some remodeling of their home, but they decided, they said, you know what, there's just too much going on, and I don't want to start something and then the cost of this go up because of what's happening, and which there's some truth to that. I mean, the reality is, yes, if you start something and then the costs go up because we're not getting...
Or get it done really quick.
Yes, right?
Get it done now.
Yeah, so that was interesting you say that, because the aftermath of some of the things potentially we'll see down the line. And so a couple other things as we're over this last week in talking with clients. So we recently had a client that is going through, they're not done with their divorce, but they're going through a divorce right now. So they're navigating through that, but they recently sold their home and ended up with a nice lump sum of money from the proceeds from the sale of the home. And so kind of taking a step back and revisiting their expenses, their budget, their lifestyle, how much money they need. They have Social Security coming in. So we were able to put together an investment strategy for them to have some growth, but also generate some income. But once again, there's things that come up that are, if you have a lump sum of money and we're, buying into the market based on the long-term plan. So those are types of things that come up. Unfortunately, life events happen, and that's what we're here for, is to really revisit, because sometimes you have a financial plan in place, but then things change in your life. So those are some things that we can revisit.
And I think that's a really good point that you bring up, because life events do happen.
Yes.
And we did have a client who came in this week who oftentimes when a spouse passes away, there's a, instinct of wanting to rush to sell the house, but maybe it's better to, put the pause on it and not make any permanent decisions right away. But what we discovered, or rather what I discovered, and I've been in this business, the tax business, for 26 years, and I had never really realized this, is if your spouse passes away, so there's something called the Section 121 exclusion, and that's basically if you have lived in your home for 2 out of 5 years and you've owned the home for the same period, you can exclude up to $250,000 of capital gains when you sell per spouse. Mm-hmm. What I didn't realize, because California is a community property state, and we get what's called a full stepped-up basis. So whatever the value, if you turn around and sell the house right away, you don't pay any capital gains tax. But what I didn't realize is if
How
you
soon is right away?
Mm-hmm. Within 2 years.
Within 2 years.
So you actually can wait up to 2 years, and you still can exclude that full $500,000. So I thought that was and really interesting because if the market is quickly, the real estate market is going up dramatically, that might actually help you.
So if the house did go up in value from the time that person, the spouse, died, you get the $500,000 exclusion. But if the house increased in value, still, I would assume you're paying some tax on that. But
not necessarily. So it really just depends on the situation.
Wow.
But the big takeaway for me was you don't have to turn around and sell it in the same year that your spouse passed away. You can actually, you have a little bit of time to evaluate and meet with your advisors and adjust and figure out, do I want to stay here? Does it make sense to sell? What's best for the situation?
And then the other thing that came up was looking at the date of death. So we've actually had a couple clients. They had family members that passed away in the fall of last year. And here we are 6 months later, and the stock market has changed a little bit since then. And so it's higher and for some of these clients. And so we were revisiting, does it make sense to look at the alternate date of death? Do you want to share a little bit about that?
It's an election that you make when you file a tax return, where you decide either you value your assets based off of date of death values, or you can look out 6 months and make a decision. Does that make more sense for your situation? But everybody's situation is different, so you want to make sure that you're consulting your estate planning attorneys and tax advisors and financial planners.
Because we also were realizing we wanted to consider is the real estate during that time period, because once again, the investable assets might be one picture, but then the overall picture with the real estate, that might be different. So you have to look at what's best.
And
overall.
some of this also comes into play for the estate tax return and what's the value of the assets, because your gross taxable estate, I mean, it's pretty high. Is it $15 million still, or is that for last year? Sorry, I don't know what year I'm living in. But that also plays into the estate tax as well as income tax.
then I just came across an article with Think Advisor, and it was the article was about when a client wants to help their child buy a home. And so it comes up pretty often. And when we do financial plans, that's usually a goal that we earmark. They want to do a down payment or help them in some capacity. It also comes up occasionally where they say, well, can I change the title and give them the property? But that doesn't make sense usually.
That doesn't make sense because if you add your child to the title of your home, then the step up in basis is not available when you pass away. So they end up paying tax on whatever the appreciation is. So that's not necessarily something you want to do.
Yeah, but there are many times that I just want to give my family this home, or I just want to, and the reality is,
make
like
sure you
said,
consult with your advisors first.
And so the other thing I hear about is sometimes, we're here in California. We do have clients all over the U.S., but the cost of living here is pretty expensive. So a few things to consider is sometimes they look out of state. Or, do you look at a studio or a condo or something to transition into a home? Because I think sometimes the idea of, I have to buy this house, the reality is there is, those stepping stones. I think my first property we bought was a condo, and then over the years we transitioned. But I didn't start with a big house. So,
right, you got to start small, especially in California.
Yeah, but I think everyone has that expectation. Like, I want a house, and this
you
is
don't necessarily want to buy the dream home. You can use the Section 121 exclusion, and every 2 years you can actually exclude $250,000 per individual. So you can move up.
Exactly.
So now that we're a week out of taxes,
T-minus eight days after.
Although I'm sure there's more deadlines to come. So.
Always deadlines. But one of the things that people ask right now is, where's my refund?
Oh, yes.
If they're getting a refund. And so what I just wanted to offer, there are a couple of ways for you to check if you are due a refund. If you don't have an individual online account yet with the IRS, it's a really great portal that you can go in. You can download all sorts of notifications. You can see what your tax payments were. You can download tax returns. You actually, at this point, I believe for 2024, 25, and now 26, download W-2s and 1099s. And so if you have misplaced something, you actually can go online and download those. But you also can find out if you are looking for your refund, where is it? And typically right now it's about 21 days. So if you file your return around April 15th, you've got 2 more weeks to wait.
And then obviously it's going forward. I had some conversations with clients kind of revisiting. They paid their taxes, and now going forward, their estimated taxes. And it seems like for some reason, like everybody owed a little more or money, or people made more money last year.
It felt like that. And one of the things that I'm really looking at with clients right now is what are the changes for 2026? Mm-hmm. And one of the big things that I've been digging into is charitable deductions, and what does that look like? And so for tax year 2026, there is a reinstated charitable deduction that allows non-itemizers to deduct cash donations mm-hmm. to charity. And that's up to $1,000 for single filers and $2,000 for married couples. So I believe 2020, 2021, if you made donations and you didn't itemize, you were allowed, I think it was $300 one year or $600, mm-hmm. something like that. So it is up to $1,000 for single filers and $2,000 for couples for 2026. So, and this is not, for instance, if you go give clothing to the Salvation Army or Goodwill or one of the thrift stores, it's just if you wrote a check, if you made a payment online, that sort of deduction. Another thing to look at is they're really changing the face of what itemized deductions and charitable donations look like for 26. So starting in the beginning of this year, if you're in the 37% bracket, your donations are going to be capped at 35%. So if you're close to being in the 37% bracket, you may want to work with advisors to bring down your income to be in the 35% bracket. And then the other thing that they are doing is if you make donations in excess of that $1,000 or $2,000, which is above the line deduction, it's going to get a haircut of 0.5%. And what that basically means is if you made, let's just say your income was $300,000, you can only deduct your charitable donations in excess of $1,500. So you'd lose about $1,500. So they've changed it a lot. it's, I think, important more than ever, to work with advisors because the laws just keep changing.
Can you explain the 35%, 37% tax bracket?
I could on the next podcast because
Okay.
I'm still figuring out how they're going to roll it out.
Yeah, that seems.
It's really tricky. I think basically you're going to lose 35 cents for every dollar of donations that you donate. I'm not sure yet how that's going to work yet.
Okay.
I think that
Stay
regulations, stay tuned. The regulations still need to come out.
Okay.
And then as you're talking about charitable giving, I know we've talked about this a lot in the past, so we'll just kind of bring this back, is for those clients that are taking required minimum distributions, or if you qualify for them now, you can do the qualified charitable distribution.
That's a great point.
To cover part of that. So once again, if you are donating and this is new for you, you can shift it to the
And
QCD.
honestly, even if you're not taking your required minimums yet, but you're over 70 and a half,
Yes.
you can give part of your IRA directly to the charity and it doesn't count as income and you still get the feel good of having given money to charity.
Yeah. So
Like up
there's
to $100,000, if I'm not mistaken, right?
May have gone up, been indexed.
wow.
Mhm.
Good.
Yeah.
so just some other kind of
And those caps that I just talked about don't apply to qualified charitable distributions.
great.
Yeah.
All right, so I think we covered a lot of ground today. Once again, if you have a life event or a change, or you just want to chat and talk about your current situation or have a review, we're available anytime. Please give us a call. And we do want to thank you for joining us today. And until next time, happy investing.
Please stay tuned for important disclosures. The opinions expressed in this program are for general informational purposes only and are not intended to provide specific advice or recommendations for any individual or on any specific security. It is only intended to provide education about the financial industry. To determine which investments may be appropriate for you, consult your financial advisor prior to investing. Any past performance discussed during this program is no guarantee of future results. Any indices referenced for comparison are unmanaged and cannot be invested into directly. As always, please remember investing involves risk and possible loss of principal capital. Please seek advice from a licensed professional. WWM Financial is a registered investment advisor with the SEC.